Most homeowners think their mortgage payment builds equity from month one. The amortization schedule says the first 8 years are almost entirely interest. Here's the exact math. When you take out a $400,000 30-year mortgage at 7%, your monthly payment is $2,661. That feels like progress. You're paying down a house. But here's what most buyers don't realize. In year one, $27,820 of your $31,932 in payments goes to interest. Only $4,112 reduces your principal. That's 87% interest, 13% equity. The common assumption is that your payment splits evenly between interest and principal. It doesn't. Amortization front-loads interest because the loan balance is highest at the start. The bank calculates interest on the remaining principal every month, so early payments are almost entirely servicing the debt, not reducing it. This isn't hidden. It's printed on every mortgage disclosure. But most buyers never look past the monthly payment number. They see $2,661 and assume they're buying $2,661 worth of house every month. They're not. Here's the actual breakdown on that $400,000 loan over the first 10 years. Year 1, $27,820 interest, $4,112 principal. Year 5, $26,115 interest, $5,817 principal. Year 10, $23,416 interest, $8,516 principal. After a full decade of payments, you've sent the bank $319,320. Your loan balance is still $338,248. You've reduced your debt by $61,752. The rest, $257,568, went to interest. 6% interest over the first 10 years. You're a decade in, you've paid over $300,000, and you still owe 85% of the original loan. Now add property taxes, insurance, and maintenance. On a $400,000 home, that's roughly $8,000 annually in taxes, $1,800 in insurance, and 1% of home value per year in maintenance, $4,000. That's $13,800 per year in non-equity costs. Over 10 years, that's $138,000 on top of the $257,568 in interest. Total outflow, $395,568. Equity gained, $61,752. The effective cost of living in that home for 10 years before any appreciation is $333,816, and your loan balance is still $338,248. If the home appreciated at the historical average of 4% annually, it's now worth $592,092. Your equity position is $253,844. That sounds good until you subtract the $395,568 in sunk costs. Your net position after 10 years is negative $141,724 before selling costs. Here's the part that surprises people. The interest to principal ratio doesn't reach 50-50 until year 21. Month 247 of a 30-year mortgage is the first time your principal payment exceeds your interest payment. That's 2/3 of the way through the loan. Why does this matter? Because the average homeowner sells or refinances after 7 years. That means most people never reach the phase where their payments are actually building equity faster than servicing debt. They reset the clock with every move. Let's say you buy that $400,000 home, pay it down for 7 years, then sell and buy a $550,000 home with a new 30-year mortgage. You just restarted the amortization curve. Year 1 of the new loan, 87% interest again. You're not climbing out, you're resetting. The mortgage industry is designed around this behavior. Lenders make the most money on the front end of the loan. Refinancing and moving every 5 to 10 years keeps borrowers in the high interest phase indefinitely. The 30-year mortgage isn't a 30-year wealth-building tool for most people. It's a 7-year interest extraction mechanism that repeats. 5%. Monthly payment, $3,484. Higher, yes. But in year 1, $18,716 goes to interest and $23,092 goes to principal. That's 45% interest, 55% equity from day one. After 7 years, You've paid $149,153 in interest and $143,903 in principal. Your loan balance is $256,097. You've built $143,903 in equity through payment alone. On the 30-year, $61,752. The difference in equity after 7 years is $82,151. That's real. That's the cost of the lower payment. If you're buying a home, request the full amortization schedule before you close. It's a single-page table showing exactly how much of each payment goes to interest versus principal for the entire loan. Read year 1, year 5, year 10. Then run the math on a 15-year loan. If the payment is within reach, even if it's tight, the equity curve is fundamentally different. You're building wealth instead of renting money. If you're already in a 30-year mortgage and you're in the first 10 years, consider this. Every extra dollar you send toward principal skips ahead on the amortization table. A single $1,000 extra payment in year 2 eliminates a future month's interest charge. That's a guaranteed return equal to your mortgage rate. 7% risk-free in today's environment. No investment beats that on a risk-adjusted basis. Subscribe for more financial structure analysis that nobody else is walking through. Not financial advice, educational content only.